Hey, welcome to the Note Investor Podcast. I'm Dan Deppen, and today I'm joined by Jay Redding from Cassidy Investment Group. Jay, how's it going?
It's going fantastic, Dan. Great to be here. Thank you for the opportunity for us to talk. It's great.
Yeah, of course. I mean, you're an experienced hand in the business, so I thought it'd be great to have you on and kind of talk about some of the things that maybe you've done in the past, or also like what you've been working on this year. So maybe you could start by just giving us like a little bit of background.
Sure. Um, I'll cover just kind of my background, what I've done, and what we're currently doing right now. I did my first real estate deal in 2004. It's coming up on 20 years already. Holy cow, it doesn't seem like that.
Mm-hmm.
But essentially, we've completed over 100 retail flips. We currently have 40 rentals that we still manage. We self-manage. When I say we, it's my son-in-law, Kyle Cassidy, and myself. We self-manage and run everything, and all of our rentals are within 30 minutes of our office. So it was specifically designed that way. So it's very local.
Mm-hmm. And what area is that in?
That is in Fort Wayne, Indiana. Good
Yep.
old Fort Wayne, Indiana. So,
Mm-hmm.
Over the years, we've purchased tax liens. I invest via self-directed IRAs. I mean, I've done flips in the self-directed IRAs. I've done the notes, tax liens, and actually had a rental in there. So we pretty much have done it all within self-directed IRA space in that respect. And now, we started Cassidy Investment Group here a few years ago, and that is our note company. And we are essentially we're focusing on building and growing our note portfolio is what we're doing. Our intended plan is, as the note business continues to grow and expand, we will pull back a little bit on the number of rentals that we have and probably move some of them over to a management company that a couple of them that we trust here in town, and just focus exclusively on the notes. That's what we're doing.
Have you considered converting any of those rentals to notes? I've never done that by myself, but I know a lot of people are doing that or looking at it. Yeah.
Well, we've done a subject to. We do seller financing as well. Actually, I've done a fair number of seller financing from the tax liens that we have purchased. We've purchased, rehab it, and then seller financed it. So, but we have two properties right now that we are in the process of doing the final rehabs that have been part of our portfolio, just part of a natural turnover. We decided that we would see if we can sell them on terms, and so we'll let you know in the future. Don't know, they're not in the market yet, but we've got them being rehabbed right now.
Yeah, no, I just know that that's a place some people were looking at as they were, especially if they're self-managing rentals, as they want to like step back and be a little bit less active. Sometimes they'll basically sell the property to, the renter or somebody else and turn it into a note. So they're still getting cash flow out of it, but not necessarily doing as much work month to month.
And that is our plan. That's kind of our plan for when we look to scale down. It may be the renter, it may not be, not necessarily, the renter needs to qualify. Okay. And not all renters are going to be Dodd-Frank ability to repay in that respect. And we want people to have a significant skin in the game to start out with. In most of the situations, it's a little bit more difficult, although we do offer a program in our rentals that allow them to earn rent credits. It's just something that we provide for everyone, and we've had a couple of people that have taken advantage of that over the years, and that's been great. Matter of fact, one couple that took advantage of it, we basically financed them, and then they just recently refinanced us out. So it was
interesting.
Yeah, so it was a good payday all the way around. So
yeah. So when you do that seller financing, what do you do to validate the ability to repay and that it meets Dodd-Frank and state fact standards and all that fun stuff?
Sure. Great question. I'm going to give a plug here to calltheunderwriter.com. All right. Max Bailey. We basically run whenever we're going to do a seller finance that's an owner occupant, we will run them through Max's program. All right, and they will complete the exact same forms that they would for a mortgage company. We are the ultimate underwriter, though. Max basically just documents everything, whether they may meet the ATR requirement, and then we decide whether we think that they are a good fit to be able to pay the loan back. We look for, particularly, we're looking at a debt to income ratio. What we like, you can go higher than this, but we want to see it 45% or below. That's what we're essentially looking at. And the last few that we have done, they've been actually in the upper 20s. So
that's debt to income ratio.
Debt to income ratio, yeah, debt to income ratio. And that makes for a very stable, very good paying note for the long term, and that's what we strive to achieve.
Yeah, Call the Underwriter is great. I've used them as well.
Yeah,
to originate a few.
I really don't. Some people want to know, what's the credit score and whatever. I really don't care what their credit score is, to be honest. All right. To me, I want to know the debt to income ratio, because that gives us a more realistic view of what their total debt burden is with the house payment, all right, to what their income is. Now, if they have, if they have the credit score, that's fine, and obviously Max pulls that. But we have lent to people who have no credit score, okay, and they have performed just perfectly fine. So, I don't. We will get the credit score, but we do not base our decision upon the credit score. If they have a bad credit score, I want to know why they have a bad. It's a red flag to dig deeper. That's what it essentially is. Is it just poor money management, or did they have a catastrophic situation, like a health situation that they got all kinds of medical bills, or something along that line? If people were good beforehand, they had a catastrophic situation, they're still good people, they're going to pull out of that in time. We'll work with those people. If it's just a long history of poor money management that's taking place and they don't know what they're doing, or they're just not responsible, then that's a totally different ball game. Then those people would not make it through.
That's good that you dig a little deeper on that, right? Because your point, there is a difference between some kind of a health event, or maybe like a job loss that those create problems, but they can also be kind of transient events that people come through afterwards.
Yeah, we learned that when we were doing a fair number of lease options. When we were doing the flips, we would help people get in and do a lease option for. Now we had a pretty short lease option period. Typically, we would not lease option unless they were within a year of bank qualifying. But what we essentially discovered is that many situations like that is that, okay, they just had a catastrophic event to happen. Maybe it was a divorce, maybe it was a health issue, a job loss, that they got behind on some things and now they're back to, they have a job yet, but their credit hasn't caught back up, that type of thing. Those are good people. They're going to be fine. You just got to dig deeper and find out what the whole situation is. What's the cause for what the score is.
Yeah, they're different deals, but I've had a bunch of those on when I've bought non-performing loans. If the borrower became non-performing because one of those transient events, well, then they're usually able to get back on track, versus the perpetual deadbeat that, you could give them a Scarface duffel bag full of cash and they're still not going to make payments.
Exactly.
So today, when you're out there buying notes, like what kind of notes are you looking at and acquiring?
Yeah, we will definitely look at NPLs. We'll do that, but as you well know, they're not as plentiful, and it's a totally different type of situation than it was back in the Great Recession. Most of the NPLs in the space at this moment in time, they have equity that's behind them, and the pricing structure has changed dramatically, and it's a little harder to find a really good deal, at least in my opinion. They're out there, but you got to dig a lot deeper to find them. So,
yeah, I bought 2 earlier this year, but it had been a little while since I had bought any, and they're very hit or miss. You can't.
Yeah.
I don't know that these days you can really you really want to target NPLs like as a business model, because you're just, it's hard to find the right ones at the right price.
Yeah, I agree. I totally agree. I'm always on the lookout. It's like, a one-off type of scenario, but as running a whole business model off of that right now, I don't think that's a good play at this moment. I would totally agree with you. So what we're doing, we're buying performing, all right, and sub-performing, all right. What we basically do, we would utilize our own capital to purchase the note, and then we essentially either hypothecate or partial out to our private capital. That's what we do. And we're still we still do quite a bit with friends, family, and associates. We've had a number of private lenders that have worked with us over the years on the real estate side, and we've been transitioning them over to the note side, and everything has been going pretty well. We essentially pay and above. I won't say it because the SEC rules. I will not say specifically what we are paying. All right.
Yeah. What you're saying, what you're paying to investors when
Yeah. So, but we are paying an above average return, above average fixed rate return. And then we buy at a deeper discount, and then we typically like to hypothecate, and we turn around and then we take that spread. Then the spread on a monthly basis is what we keep, and the private lender gets paid every month.
Gotcha. Maybe you can talk a little bit about how you set those up and how those work. I've been talking a little more about hypothecations lately, but it's an ugly word that like causes a lot of confusion. So.
It's a big word that sounds really scary. Okay.
Yeah.
It's nothing more than a loan. Okay. It's essentially, it's just like from the real estate side. All right. You're pledging the collateral. All right. As security for the loan that you're taking out from the private lender. All right. It's the same exact thing. So what's our collateral in this situation? Our collateral is, we have the legal right to collect the debt. That is our collateral, which is backed by the real estate itself that secures that our position. So as an example, all right, one of the things that we do to make sure that we protect ourselves as well as protect our private investors is that we will not go anything greater than 70% our investment to value of the asset that's backing the loan. We will not go any higher than 70%, because we want a 30% spread in there in case that loan goes bad, that we can take it through foreclosure.
And value being the unpaid balance there, or the value of the property?
Value of the asset backing the loan.
Okay. Gotcha.
So if we need to take it through foreclosure, we can take it through foreclosure, and the likelihood that it will sell at the share sale is very high. It would makes us whole, which makes our private lenders whole at that point.
That makes sense.
Yeah, so that's one of the things that we do to protect ourselves. How we essentially do it is we pledge our legal rights, all right, to collect the debt as the collateral on the loan that we're taking out from the private lender. Now, what we typically will buy the entire note. All right. We do purchase partials also. We've done that. I'm going to use this as an example of something that we do. Is sometimes this varies a little bit, but say we purchase a note at a discount of say a 13 or 14% yield. Okay. All right. So a significant discount, and then the amount of money that we have in the deal. All right, we will borrow that from a private lender, all right, and say we will pay them either 7 or 8%. We will pay above what a CD is, above what fixed rate returns are. We usually do 1% or 2% above what the fixed rate returns are. All right, and then there's a promissory note, and then there's a collateral agreement. That's what there is. And how we set it up is that we have an attorney that acts as the escrow agent, all right, and all of the legal documents are held in his possession. And then we also sign a dry allonge and assignment that if at any time we default on the terms of what that note is, the lender can go to the attorney and provide proof that we've not performed as we stated. And if they want, then, and the attorney agrees at that point, then it can be assigned, that note could be assigned directly over to them.
Yeah, that's kind of an interesting way to do it, because it makes life easy for the investor in the event that the operator for some reason doesn't come through. But then I guess in that case, the attorney is kind of like the final arbiter of what, because often I've never had anything like that happen on a hypothecated loan, but like in my normal loans with borrowers, like there's often, like they usually dispute and they say, hey, I made these payments, and I'm like, servicer didn't get them. So I guess in that case, if that were to happen, then the attorney would be the one to have to figure out.
Well, we have
What's
the specific, we have the specific language in there as far as what it looks like as far as default. And if we hit these targets, if any of these types of things happen, then that's a default of our agreement. Now, we do reserve the right to be able to suspend. This is the little twist, okay? And we cover this with every private, every capital partner. We do reserve the right to be able to suspend payments if the borrower gets further than 90 days behind, if we so choose. And we do that so that we can make a decision at that point whether we're going to pursue foreclosure or what's the best strategy. Now, we've never had to do that, okay? We always keep plenty of money in reserves, all right, to make sure that we can keep, our private, continue to keep paying our private lenders, but we do reserve that right in case it gets to a tough situation. And the thing is that the private lender or the capital partner's interest continues to accrue, just as our interest would continue to accrue on the loan until we get through the foreclosure process. And if we take it all the way through foreclosure, then all the interest plus the principal that is due to the capital partner gets paid at that time, at the same time that we get paid. And we get made whole as well.
No, that sounds good. And that's kind of similar to what I do. And what I like to do is just set up monthly auto pays through the bill paying, and then just
that's what we do.
Let them run. And I have had to foreclose on loans that were underlying hypothecated loans before. That I have had that happen to me before, but I find it the same way. For one, I always keep a lot of cash around.
Yeah.
And two, I find it seems like it's just going to create more of a headache if you stop making payments to the investor, even though you might be entitled to do that. Like, what's the point if you don't need to? It just creates an issue that you don't need
that you really don't need. But we have it in there. Like I said, we've never had to exercise this. In 20 years of working with capital partners and everything, we have never been late once. All right, to any of our there has been no capital partner that has ever lost a dime with us. I'll take the sword long before I ever allow them to ever take a loss of a penny.
I think it's a good term to have just in case there's some black swan event. Some nuclear war worldwide, whatever, where like all the loans stop performing, right? And then you have
the chances of every loan that you have in your portfolio is going to stop all at once is pretty slim. But could it?
It is. It's funny when at the onset of COVID, I thought it was going to happen. And I was like, oh man, I need to buckle up because this is going to get weird. Of course, the opposite happened. They did all the stimmies and everything, and the portfolio just chunked along like nothing happened. But mentally, I was like, oh, this is the big one. But so it hasn't happened yet.
All paid during COVID. Okay. We helped a lot of our rental people to be able to get stimulus funds, all right, and assistance in that. And they pretty much all paid during that time. I think there was only maybe one that we really had to work hard with, but by and large, it took a lot of extra work though. I have to admit, it was a lot of extra work during that time.
Yeah, mine were similar. Like my default rate, I mean, I still had some that didn't pay during COVID, but it was really the same rate that I probably had before.
Sure.
And then at some point when we got on the back side of it, I basically declared COVID over and then started legal on a bunch of them, and then most of
Yeah.
them reinstated. Yeah.
When the pressure came on, they performed. They were just going for the
Yeah.
free ride.
There
Yeah.
were a few that were doing the free ride, and then the free ride ended, and we got it all worked out.
Sometimes just people need to know that you're serious when you say, if you get, I have a couple, we have a couple of notes that they get close to the 90 days, or they may slip into that 90-day default, and then they get the demand letter, and then they pay 2 or 3 months at one shot and get caught up. And it's like, it's just the nature of this game. So
Yeah, and I actually like those loans because I can buy those loans at a bigger discount.
discount, sure.
And I kind of know, yeah, to your point, it's a little bit of a hassle because you got to do a few more things to keep up on it. There's like a little bit more friction, but you're going to get your 11, 12 payments every year at the end of the day. So that's why I don't worry about it too much month to month. I know it's going to be scratchy, but over the course of the year, it's going to pan out.
Yeah, we don't worry about if they're a few days late. We consider it, in our eyes, if the borrower is paying within the month that the note payment is due, all right, then they're on time. I don't care if they're 15 or 20 days late. Yeah, we build into the notes that we create. Obviously, there's a late fee that's in there. Not all the notes do have that, but we build it in. But they're on time as long as if they're in that 30-day window, and we just don't sweat anything with that. That's just kind of nature of this
Right.
business. Yeah.
So I have to ask, so I didn't prep you for this, but what's your craziest borrower story? Like, do you ever talk to the borrowers directly, or?
I try not to be honest. I try not to. I had to talk with one that we had up in Michigan here just recently. And the whole thing was, we had asked for her a couple times to get her essentially the mortgagee clause corrected, because we had purchased a note, and we'd asked her a couple times to get the mortgagee clause changed over to us as being the mortgagee instead of the previous owner. And no response. And we have this boarded at FCI, and I get this dingy letter from FCI that, I don't have them on a full service because she'd been paying for a long time, so I didn't have them on a full service thing. So it's like, we're going to start charging you $25 every time we get this, and because you're on limited service at this time. So I reached out to her and I called her. She's a very nice lady and everything, and she just didn't know how to do it. That's all it was. So I explained.
Yeah.
I explained to her, all you got to do is just call your insurance agent, and I gave her the name and address and everything, and 10 days later, bingo, it was done. So, sometimes it's just the simple things like that. You don't think, you think they're ignoring you, and they kind of are, but they just don't know what to do. So it's like, okay, if it's a big enough issue, he'll get a hold of me. And it's like, yeah, this is a big issue. This is this is important.
It's amazing what people will ignore sometimes too. Like there are some, like I've had borrowers. I had one guy, I had to start foreclosure multiple times, and like multiple times he reinstated, like at the end. It's like, this dude he likes the place. He's not going anywhere, but he's not going to pay every month. Like if someone put a gun to his head, you'd be like, sorry. But as soon as it gets up to where it's like, okay, you're going to lose the house now. All right. Then
okay.
And it's ridiculous because then, he also incurs, late fees and back interest, and, then he doesn't pay the taxes. I mean, some counties are harsh in the interest and penalties they apply.
Oh, yes.
Especially in Michigan, it seems like there's a lot of counties that do that. And then it's always funny when I have borrowers like will get mad at me. They're like, well, why are the penalties so high for the delinquent taxes? I'm like, lady, I don't collect them. That's not my thing. I'm not, you got to go talk to the county.
Talk to
about
the
that.
county people.
Yeah.
They wouldn't be that high if you'd paid them on time,
Well, that's the thing. Like people can delay a crazy amount, but it always costs them more. And I never quite understood that. There's no benefit. There's no upside.
You pay so much more in the long run over the term, all right, if you're not paying on time. So But
Yeah.
yeah,
And the ones that crack me up are where they have like a $300-400 monthly payment that they won't pay, but then at the last minute they'll do a reinstatement for like $7,000.
yeah.
I've had a bunch of those. I've had like 6 or 7. And I'm always curious, like, did they rob a bank? Did they borrow money from a friend they're not going to pay back?
Where was
Like,
that money all at? Yeah.
were they really just rat holing it the whole time? And then they were like, I never asked, but I'm always curious, like what the backstory is.
So we don't really have, I'll be honest, we don't really have any payments that low. We kind of target 500 and above. All right.
Mhm.
For what we do to make it worth our time to be able to get a spread in there, that payment's got to be at least above 500. The P&I payment's got to be at least above 500. And quite honestly, we like it to being closer to 1,000. That's what we do.
Yeah, bigger is better with hypothecations. And for people that don't understand, that are not familiar with the math on that, right? So if you're hypothecating a loan, you're collecting a payment from an investor, say it's the $1,000, you're paying your servicer, whatever that costs per month, and then you're paying the investor.
The loan, right?
Well, right. Yeah. If it's a seller finance loan, if you might have it built, I do have loans like that too, where the borrower pays. Yeah. But yeah, you need to create a spread. But if you've got like a teensy $200 a month payment,
there's no spread.
There's no spread.
Right. That's exactly right.
To go there.
Yeah. On our target, we want to spread of at least 200 a month is what we want. We've got some that are larger than that, but that's a minimum that we're going to go for. So we're typically in the 700 to 1,200 range is typically where we're at on the P&I payment. And you tend to have a better quality asset to back that as well.
Yeah, that's true. Like, I think when you get into that asset range, you're going to tend to have fewer borrower issues.
So
as well, and probably better
so.
value of property if you do have to foreclose. Yeah.
Yes, I hope so. I mean, that's the thought process anyway. As you well know, they can all get trashed no matter what level they're at.
Oh, I know. I've got I'll talk about this eventually on another podcast, but I just found yesterday I had an REO that had some crazy vandalism.
Oh, okay.
Done. Yeah, so I got to work on an insurance claim for that. Okay. Not the first time that's happened, but it does. So yeah. So what's next for you? So like, what are you focusing on the rest of the year? Is it more what you've been doing, or?
Yes, we're focusing on. We'd like to get at least 6 or 7 more notes into our portfolio before the end of the year. So it's always the combination of raising capital and getting notes and trying to balance that out. When you got the notes, you got the capital. It's just always that that thing. We're debating whether when and if we want to go to creating a fund. If we do decide to go do a fund, we want to have a lot of flexibility to. I don't want to. At least this is our thoughts at this moment in time, I should say, is that I don't want to necessarily do a fund and then have to redo it again in 10 years. Okay, so I much would rather look at an open fund and be able to shift to real estate, to notes, to if it's a flip, based upon where we're at in the market cycle. Because as you well know, there's certain strategies are better in certain stages of the cycle than others, or if it's in tax lien scenarios, those types of things. So
and I think that makes sense, because sometimes I've seen like people will set up funds, and in the documents, like, they'll be very specific about this is what we're doing and this is the strategy, but then market conditions change.
Shift. Yeah, they do. They shift. Now you're in trouble. Yeah.
Well, yeah. And so for me, if as an investor, if I'm putting money in a fund, what I'm really doing is putting my faith in that operator.
Sure.
So I think it makes sense to have as much flexibility as possible. Actually, I would want that as the investor too. So that way my operator can adjust as needed. And if like one thing dries up and there's this opportunity over there, then they have the ability to shift around as needed.
I'll be honest, we have not done too many flips lately, just because of the pricing structure. The margins are a lot tighter.
Mm-hmm.
If you're going to invest that high of amount of money, your margins have to be wider. Our goal is to make a 20% return. All right, when we do a flip, a net 20. All right, well, looking at what the wholesalers are doing, what they're pricing stuff at, and everything, it's like, yeah, I'm not going to do this for 10 grand on 100,000, or for a $180,000 to $200,000 home. I'm not going to do this for 10, 15 grand because that's what it's going to be. All right.
Well, right, because it's a lot of work, and then there's risk in there.
Oh, there's huge risk
as well. Yeah.
So, we've done a couple, but they've been kind of unique situations of where we knew a family member, a friend of ours, family member. So we actually made an agreement, and we got our 20% out of that, what we wanted to make, and help them out. And then another one we recently purchased a subject to property that we rehabbed and sold that on lane contract. All right, or contract. And we're staying in the middle of that one purposely.
Okay, maybe you can talk a little bit about how those subject to deals work. Like, I know that's kind of a hot topic with the interest rate environment and where they are. That's another one I haven't done myself.
So. Okay. This particular one, kind of the backstory on it. The couple who owned the property, they had moved to Florida. That's what they had done. They had moved to Florida, and they had bought it. They had to pay a little over 2 years on the loan. It was an FHA loan, 30-year FHA, interest rate 3%. So that was what was very attractive, obviously. But they had, for family reasons, they had to go back to Florida to help take care of family, that type of thing. And they were going to try and sell their house. They had a little bit of equity in it, but they had a friend that begged them to rent it. So they thought, okay, we'll rent it to this. Our payment's slow. We'll make a little money. And of course, that ended up being a disaster for them. That's why it ended up happening, because the friend didn't take care of the property. They trashed it. And they did not have, they were relying on the income from that rental to pay their mortgage payment. So they didn't have the money to pay their mortgage payment, and they didn't have the money to rehab the property.
Doesn't sound like much of a friend.
Not much of a friend. I don't think that one would be mine, that's for sure. So a realtor actually brought the deal to us. We talked with them, and we did some unique things in this. They did have some equity. They wanted some equity out of it, but I wasn't willing to pay them all the equity right now. So what I essentially did, we actually created just a straight promissory note, an unsecured note, all right, for $10,000 to be paid in 10 years. No interest, no nothing, just to be paid in 10 years down the road. Because looking at the amortization schedule, we could afford to do that then at that point. So that was one thing. And then we took it subject to the loan that was in place. We rehabbed the property. We found a new buyer. We sold the property to them on basically terms, contract for deed, and we stay in the middle, okay? Because I'm making sure the seller to us, all right, their payment is an ACH payment directly out of our company every month. So it's being paid every month automatic. I want to make sure they're whole, whether the end buyer pays or not. Okay. So, so the spread on that is about $800 a month. So that's a good spread on the monthly cash flow.
Right. And I'm guessing, was that an unrecorded land contract? So you're not triggering a due on sale clause or anything like that?
Well, you know what? I could, we did record it. Okay. Here's the things. And that's you bring up a great question. Everyone is concerned about the due on sale clause. All right. Here's a couple things, and I may end up being proven wrong on this. Okay. This particular note had been paid on for over 2 years. It's already been securitized. It's in someone's retirement fund. It's in some hedge fund out here. Unless you give the lender a reason to go looking, all right, I don't think there's going to be an issue. Okay. So
right. Unless, like, for some reason they stopped receiving payments or something. Yeah.
Yeah. So here's what we basically did. We made it so that it's an automatic ACH payment. They were like two payments behind, so we got them caught up immediately, and then we've got it on ACH, so it's pulled out. The third actually gets pulled out tomorrow. the 3rd of every month, so it's automatic. And we did transfer the deed over to us, so we have the deed. It's in our company name. Insurance-wise, that's the biggest thing. Okay. Now, I know there's different philosophies on that. I'll share with what I did in my philosophy. I talked with both the seller as well as the end buyer, explaining what the situation was. And I said that the safest way for us to do this is that we have both of your names on the primary loan.
Mm-hmm.
Okay. Because the lender is going to want the person that we bought the property off of, they're going to want that to be the primary insured.
Uh-huh.
I know there's some philosophies out there saying as long as it is additional insured that you're okay. But if I was a primary lender from a bank standpoint, I wouldn't be comfortable with that. I want the primary insured. So he's the primary insured with the other individual, with the person who's buying the property from us, with him also being the primary insured. Okay. We didn't try to go to insurance policies because you're going to run into a scenario where neither one will pay if there's a claim. I actually sat on a board of an insurance company, so I can tell you that for a fact, neither one will pay. All right.
Oh, so you're saying if there's two homeowners and policies on a property and there's a claim that they might.
They're each going to point at each other. It's what they're going to say. No, it's that's what it's going to happen. And it's going to end up not getting paid. Because
Gotcha.
you're not supposed to have more than one. Okay.
Okay, I did not know that.
Yeah. So all of you that are out there double insuring, you better hope there's not a claim. That's all I can say. Because as soon as the other insurance, and they will find out. Okay, there's ways that they do the checks. They will find out that there's another claim on it from another insurance company. They're going to start pointing
That's funny. It's this funny thing of the math. Like if you have 0 insurance policies, you won't get paid. If you have 1, you'll get paid. If you have 2, you won't.
We won't. Yeah.
So if you have 3, maybe you will again. Like I don't know how that.
Yeah, so that's what we did with the insurance policy, and then our company. So the first mortgagee is obviously the bank. All right, and then our company is the second mortgagee. All right, and we are then the additional insured. So for the insurance aspect, they are the primary. The bank is the primary insured, and we're secondary insured.
Gotcha.
Okay, and then as far as property taxes are concerned, we essentially we got the person that we purchased it from. We got his name on that the taxes come in his name, but also in our name to our address. So basically, what it looks like from a bank is okay, this guy, maybe he created a company, maybe he, as long as the payments are coming in, they're really not going to dig, is the bottom line. And the only thing that's going to really throw a red flag is if for some reason they go and start digging specifically for the deed. Well, we're giving them no reason to go dig for the deed because the primary borrower is the primary insured and also on the taxes.
Well, and they don't have an incentive to go dig for that because if a bank digs through their portfolio and they find a bunch of these, they could potentially trigger a bunch of loans to go bad that we're paying.
Well, that's true.
So it seems like it could be counterproductive to
what's
do
the
that.
cost to them is what is the cost to them? They have a paying loan. From their aspect, what kind of expense are they are they incurring to be able to search all this out?
Yeah.
Okay. It's time and energy is what it is. So could it get called? Yeah. And if it does, I've got multiple exit strategies on this. I can go get a private capital partner and pay out the underlying. I can do that. I could sell a partial on it and pay out the underlying. I could sell the whole note and pay out the underlying. So I've got multiple exit strategies in which to be able to protect everyone involved. And that's the most important part. All right, is making sure that you got everyone protected. Everyone's disclosed. Everyone knows what's going on. Our disclosure, we had like 3 pages of disclosures to go through that everybody understood what's going on in this scenario. So
no, and that's a good way to do it, right? Because you said you have a small probability of the bank ever carrying, and then in the event they do, then you have fallback plans
right
to take care of it. Yeah, where people get into trouble is where they stick their neck out. It's like, if this thing goes perfect, I'm good, and otherwise it's a blow up, and that's not. Yeah,
you have, my personal opinion, you have an ethical and moral responsibility to that individual that you just took their loan subject to took their property subject to the loans in place, because their credit is still on the hook for this. Okay, they are still ultimately liable on this, and actually the people's credit score is going to improve from what it was because it's getting paid every month. Okay, so you have a responsibility, and if you're not taking that seriously, I mean, there's some serious potential fraud scenarios in here if you are not taking the correct action and protecting everyone that's involved. So critically important. Don't take it lightly.
I think the longer term danger is what you said. It's like bad actors running around doing the wrong thing,
right,
and then not paying on the loans and causing blowups. Like, that's the thing that would trigger banks to start looking. Like, if they start having problems because of bad actors, then at some point they may go through and go, well, how many more of these?
How many do we have like this? Yeah, exactly.
And that was, I believe, if I understood him correctly, at the Paper Store seminar a few months ago, I think that was Tom Henderson's concern with
Sure.
some of that. It was more, not so much the specific deal, but the broader thing. But even then, as long as you have a fallback plan where you can pay that thing off, then even in that scenario, you're okay. You're not.
Yeah, there's no due on sale jail. Okay. But there is fraud jail. Okay, so we want to make sure we're good from the fraud standpoint. I'll take the risk on the do not on the
right
on the other part.
That's good. Cool. Well, Jay, thanks so much for sharing all your experiences and that little deep dive in the subject too, because I know that's an area that I've been wanting to learn more about. So how can people find you if they want to connect with you or
Sure.
learn more about working with you and that kind of stuff?
Sure. You can go to our website at Cassidy at CASSIDY investments.com, and I'm sure Dan will have that in the show notes as well. You can, we have a lot of free information if you want to learn more about notes. You can subscribe to our newsletter on there. We also do a Note Talks with Kyle and Jay on the last Thursday of every month from 12 to 1 Eastern time. And we talk all things notes. It doesn't matter whether you're a beginner, just getting started, or you're wanting to bring a deal to get a closer evaluation or another set of eyes on that. We do all of that. We typically have a couple things lined up, but we let it be driven pretty much by the people who are in attendance so that you get your questions answered for what you're trying to accomplish. And we go all kinds of different directions.
Yeah.
You can imagine how that may go.
I know, kind of like I look at the conferences, right? Like those conversations, they just go on and getting all kinds of stuff. So, well, Jay, thanks again. I really appreciate you coming on.
Appreciate it. Oh, one thing, if you want to reach out and send a direct email to me, just go jay@cassidyinvestments.com. That's mine.
All right, perfect. Well, thanks again. Catch you next time.
All right. Take care. Thank you, Dan.